Don Luskin, are you too euphoric?
I don't think so. I don't think look, I've got 78 institutional clients who represent the best and the brightest and the biggest of money management in the United States. There is not a wild-eyed euphoric optimist among them. At most, they will concede that we might have a decent 2011, and then they want to change the subject and talk about all the terrible, terrible things that are going to happen in 2012. There is no complacency. There is no irrational exuberance whatsoever.
What if some of these terrible things happen in 2011? I guess my point is, these things have a way, uncertainty, risk premiums. We're playing international politics in the Middle East. It's a tinderbox. You know that, Don. What if stuff comes up?
Well, sure it is. But Larry, remember, stocks are now 20% lower than they were 11 years ago. You're getting paid to take the risk.
Should they raise cash? I want to know. You were very bullish. You weren't worried about Libya, and you may be right. You weren't worried about Egypt. You may be right. Now, as this story continues to unfold, and oil prices and gasoline prices much higher than they were just a month ago, Don, is this a time to raise cash for investors?
I really don't think so, Larry. Stocks are 20% lower than they were 11 years ago. Come on, you're getting them cheap. Oil is more expensive than it was 2 months ago, but it's cheaper than it was 2.5 years ago. You really can't let the perfect be the enemy of the good. There's always going to be something wrong. It's never going to be perfect. When it is, that's when you sell, not now.
Perfection is the time to sell. Phil Silverman, welcome to the show. Let me just ask you, let me just get your take on this debate. The mini oil shock. Some people think, maybe I think, this could knock a 0.5 percentage point off of GDP and raise the inflation rate by 0.5%, and it's a tax on profits and a tax on consumers. Not the end of the world. This is not 1979. But I want to ask you what you would do, Phil.
I think now's the time to be a little bit cautious, given what you're just saying. I mean, if oil goes up, $20, we could see a 0.5% of GDP taken off just like that. And we're seeing oil going up tremendously with the tension in the Middle East. Now, we don't know how that's going to play out, but it's unstable there, so you've got to be cognizant of the risks on the horizon. And it's an inflationary environment even without the Middle East. I mean, we're printing a ton of dollars. And listen, the stock market's up, what, over 20% since the summer? It's time to reassess and use this volatility in the market to position yourself to what we could be seeing for the rest of 2011.
Jeff Matthews, there are faint traces of the 1970s, and I say faint. But the fact of the matter is, the Fed is pumping money into the economy like there's no tomorrow, while oil prices are going up. This was the stagflation disease of the 1970s. It did not end well. Is this a faint trace? Is that part of your view?
Yeah, I was around back then for the late part of the 70s and early 80s, and inflation's not a friend of stocks. People have this idea that it is for some reason that I don't quite understand. But disinflation and mild deflation are wonderful environments for stocks, and we don't have that right now. And I remember inflation. It's not fun. And China, really, this is very important. China has turned from an exporter of deflation to an exporter of inflation. And I think that's a pretty big deal.
Let's talk about that, Don Luskin. I had China on my card. I thank Jeff Matthews for preempting the whole discussion. What about China? China is exporting inflation. Fair enough. China also says it wants to
Wait, I don't even understand what that means, Larry. How is China exporting inflation?
Because
somebody tell me.
Go ahead, Jeff Matthews. If you don't, I will. But go ahead, Jeff. What's the link?
China's turned from a deflationary play to an inflationary play. They've got. Beijing has raised the minimum. Beijing has raised the minimum wage 20% twice this year. Costs are going up in China. Ask any apparel company what's happening over there, and instead of prices declining as they have over the last 10, 15 years out of China, they're starting to go up. That's what it is.
But do you know do you happen to know, Jeff, what the inflation rate for exports in China is? I do. It's 80 basis points.
I'm sure you do.
Do not worry about it. Just don't worry about it. Just don't worry about it. It's crazy.
But their inflation rate overall is 5%, and it's rising.
Right.
But they're not exporting that, Larry. That's internal. They're not exporting.
Yeah, but
well,
we are
ask J.C. Penney is J.C. Penney. They're exporting it to J.C. Penney.
That's right. We are importing it, Don Luskin. Now, come on, you know this. Our currencies are linked, and we feel the same price pressures through the import channel. So let me ask you this: you got a twofer here.
But we know what their inflation rate is for their exports. It's 80 basis points. That's just nothing. That's rounding error. I'm serious. It's not in the numbers, Larry.
If they keep tightening their economy to fight inflation, however you measure it, it's a 5% inflation rate. If they tighten, if they bring their growth down from a 10% average of the last 2 decades to, let's say, 7%, or maybe they undershoot, what does that do to U.S. stocks? What does that do to commodities? What does that do to our economy?
Well, if they really actually smash on the brakes, that's going to hurt world growth. We're all linked. There's no such thing as delinkage anymore. So that's not good. But I don't think that's going to happen, Larry. You know, they're looking at all this unrest around the world, and the last thing they want to do is add to their problems by having anything that even has the slightest whiff of recession. So if by tapping on the brakes they slow the car down too much, they're just going to drop on the accelerator. Don't worry about this.
All right. Well, unfortunately, Phil Silverman, I'm listening to the Chinese themselves. It was a gigantic story today. So Don Luskin may be right, but the Chinese government is saying something much different. And on top of that, Phil, I mean, I'm loaded with good news here. The dollar is at a 4-month low. The dollar. Now, I'm not sure why particularly now, but the dollar continues to slip back on the exchange indexes. What does that mean to you?
Well, you know, one would have thought that the dollar would have rallied with all the tension in the Middle East, but it didn't. And what that shows us is that there's a lot of weakness in the dollar. I mean, we're flooding the system with dollars. And until we stop doing that, there's going to be a tremendous pressure on the dollar. And so it's a difficult situation. I think China is going to be, I'm not worried about slow growth in China. I'm worried about inflation ultimately coming out of China. I know Don says it's 0.8%, but as inflation hits them and as they demand more commodities, you know, they're using a lot of oil, a lot of raw materials, and there's no way that that's not going to get to the bottom line in our corporations with profit margins so high. They'll start to mean revert.
All right, Jeff Matthews, you are the greatest living historian of Warren Buffett, okay? The greatest living historian and author of Warren Buffett. Warren Buffett is very optimistic. He is, as we said in the intro, itching to buy something. Right. I want to ask you about I love optimism. And in fact, I want to say about Warren Buffett, although I don't agree with him on the capital gains tax hike, in late 2008, he said, go ahead and buy American stocks because the worst is going to be over. It was a great call. He may have been 20% early, but I've always respected him for that great call. And he's had a very optimistic take for a couple years. So maybe I'm too pessimistic tonight. I'll be the first guy to acknowledge that. What's your take? Should we listen to Warren Buffett? What is he telling us? And incidentally, what kind of stock market impact is he going to have if he starts buying stuff left and right?
Well, he was buying stuff left and right 25 days after Lehman went out of business in 2008. That's when he put $15.5 billion to work. And then a year later, he put $25 billion to work in Burlington Northern. We're talking about a market that's already recovered and an environment that's already recovered to the point where Buffett is not running around buying stuff left and right today. All he said in his letter was that his elephant gun has been reloaded and he's got an itchy trigger finger. And everyone took that to mean Buffett wants to buy something. I was getting calls today. What do you think he's going to buy? And it's absurd. He's going to buy what he wants to buy, when he wants to buy it, at the price he wants to buy it at. And he's not going to buy it from some ARB in New York.
Well, okay.
That's not going to happen.
He won't even buy it from a CNBC anchor. But I want to ask you this. They're talking about transportation. Warren, look, the Burlington Northern thing turns out to be an awfully good buy. I think you would agree with that. Right. There's talk, Jeff, he wants to buy nuclear reactors. And by the way, did I forget to say that the Obama administration has allowed the first drilling permit since the BP spill? They're finally doing something to create some more oil. So maybe they'll have nuclear permits and drilling permits. And I guess my question to you is, will Warren Buffett be buying those energy sectors?
He may. He'll look at whatever he thinks is a lock to make him money over a very long period of time. And I think that would rule out some speculative things in technology. It rules out a lot of pharmaceutical companies, which he doesn't claim to understand. Anything that involves technology or patents, he's not big on. He likes down and dirty businesses that have a very long life to them, where market shares don't change. He loves a competitive moat. He loves franchises. And so I think anything in industrials, also perhaps in the food area. He loves brand names. He bought a piece of Mars, he bought a piece of Wrigley's with Mars a couple of years ago during the crisis. So I would look to those areas. But I wouldn't get excited. I wouldn't run around and buy stuff today just because he said his trigger finger.
Don Luskin, I'm going to give you the last word. I'm kind of excited about Warren Buffett because he sounded so optimistic, because all I've done tonight is talk about high oil prices, high gasoline prices, the threat coming out of China, and the 1970s. So I'm looking to be a little bit optimistic hook. Do you think Warren Buffett's bullishness is merited, deserved, and would would you act on it?
You know, I'm not a Buffett fan, but I happen to agree with him. And I think this is a good time to buy stocks. You know, I think that the guy's got so much money at work. He's sitting on a lot of cash, has been for a long time. He has seen stocks double over the last 2 years. He better get out that elephant gun, because those elephants are getting away.
All right, they're getting away. Thank you, gentlemen. I appreciate it very much. Jeff Matthews, Philip Silverman, and Don Luskin coming.